Hey everyone, welcome back, and if you own Apple stock, you're going to want to stick around for this one, because some big news just dropped that's got Wall Street talking. So here's the deal. Apple, yes, the most valuable company on the planet, the iPhone maker, the tech giant that basically lives in your pocket, just got downgraded by analysts, and the reasons behind it are actually really fascinating. This isn't just some random financial noise. There are three very specific concerns that are making some serious investors pump the brakes on Apple right now. Let's start with the first one, and honestly, this is probably the biggest one: iPhone sales momentum. Look, for years Apple could basically do no wrong when it came to iPhone upgrades. People lined up around the block, sales records were shattered, and Wall Street loved every minute of it. But the story is starting to shift. Upgrade cycles are slowing down. People are holding on to their phones longer. And in key markets like China, which is absolutely critical for Apple's growth story, the competition from domestic brands like Huawei is getting fiercer by the day. When your flagship product starts showing signs of fatigue, that's a red flag analysts simply cannot ignore. Now, the second reason is something Apple has been betting enormous resources on, and that's the artificial intelligence play. Apple Intelligence, their AI suite, was supposed to be this massive catalyst that got people excited about upgrading their devices again. The idea was simple: new AI features equal new iPhone demand. But here's the problem: the rollout has been slower than expected, the features haven't quite landed with the wow factor that Apple needed, and frankly, compared to what Google and Microsoft are doing in the AI space, Apple is looking a little behind the curve. When your big growth catalyst starts looking shaky, investors get nervous, and nervous investors downgrade stocks. And then there's the third reason, which is arguably the most uncomfortable one for Apple valuation. Let's be real here. Apple's stock price has been trading at a premium for a long time now. We're talking about a price-to-earnings ratio that prices in a lot of future perfection. And when you combine slowing iPhone growth with an AI strategy that hasn't fully delivered yet, analysts start asking a very uncomfortable question: is this stock actually worth what the market is paying for it right now? The answer, according to these analysts, is starting to lean toward no. When growth slows but the price stays high, something eventually has to give. Now, I want to be clear: nobody is saying Apple is in trouble as a company. This is still Apple we're talking about. They have an absolutely ironclad ecosystem, a services business that keeps growing, and a loyal customer base that is the envy of every company on earth. Tim Cook and that team are not sitting still. But the stock market isn't just about how great a company is today, it's about what happens next, and right now, what happens next for Apple has some genuine question marks hanging over it. The downgrade from Barron's is essentially a reality check. It's analysts saying, hey, the narrative that was supporting this stock price needs some fresh evidence to keep it going, and right now that evidence just isn't quite there. So what does this mean for everyday investors? Well, it's worth paying attention. Not panicking, but paying attention. Because when respected financial outlets start raising these kinds of specific concerns about the world's biggest company, it tells you something about the broader conversation happening on Wall Street right now. And here's the thought I'll leave you with: if even Apple isn't immune to a reality check, what does that say about the assumptions we're all making about the stocks we think are untouchable?